first trading session of 2017 is almost here. 2016 was a great year for equities as well as the US currency. So without further ado, let's get straight into it. I'm joined by Stephen Guilfoyle of Sarch 986 and David Williams of Strategic Gold Corporation. Gentlemen, thank you so much for joining me.
Thanks for having us, Remy.
Well, it's been quite a year for the equity markets. We saw quite a rally following the victory of President-elect Donald Trump. So that means we'll be getting a new administration in January. And we also had the Fed Reserve raise the interest rates. And they did also give us their forecast. So what does that mean for the markets in 2017?
Well, we are going to see some violence in the marketplace. It's going to get rough at some point, maybe as soon as middle January. And a lot of it is going to depend on how far we go with President-elect Trump's proposed policies. Corporate tax restructure is probably the most important one, but you also have deregulation, the repeal of Obamacare, money being repatriated from companies that have kept it overseas. All these things will matter, and what will matter most is, will the result actually meet Wall Street's expectations?
And David, what about yourself?
I agree with Stephen, but I always take a little bit of a more a bearish attitude than my partner over here. But I think that the Trump rally that we've had since his election has gotten a little out of control. I think just based on the fundamentals. And so I think that next year we're going to see a difficult time. And the reason we're going to see a difficult time is because the fundamentals haven't changed since he was elected. He's a new man, and he's going to try to do some things different, but we still have tremendous headwinds that we have to face and we have to overcome, and we'll see how that shakes out in the coming year.
And you did mention fundamentals. We got the Federal Reserve meeting, the final one, where we got a 25 basis point rate hike, and we got the forecast as well. And it was interesting that the Fed didn't raise their economic projections in terms of what we can expect. And given that the fundamentals aren't necessarily matching what we're seeing in the stock markets, what does that mean for investors in Main Street?
Well, I think the Federal Reserve, as they so commonly do, really took a pass there. I don't think if you go back and look at their economic projections from the past, they've always seen increases for the Fed funds rate without really improving their projections over a 3-year time frame for unemployment, for GDP, for inflation. So really, they almost predicted a magical interest rate increase. Now, this is a fundamental change, you're right, and this is going to make it easier for consumer finance names, for the banks, to make a little bit of money. There's actually going to be a business in lending. So I do think, while Dave is right, some of the market has gotten ahead of itself, the financials, although they are one of the leaders since the election, probably will, at least for the first part of 2016, remain among the leaders.
And so now this is where I tended to diverge from my esteemed colleague, Mr. Guilfoyle, because although the financials are doing well, and there's reason for optimism on the financial side, if you look at what happened last year when the Fed raised interest rates a quarter of a basis point, and then they said they were going to raise again this year, they waited all the way to December to raise again. Last year we struggled the entire year until Trump got elected, and then all of a sudden equities took off. Up until then, it was a one step forward, two steps back type of year for equities, and so. My thought is, it's all well and good, and financial institutions are all well and good, except for the debt levels are so tremendously elevated. Whether it's financial institutions, whether it's governmental institutions, whether it's Chinese, European, or U.S., it's a huge headwind that I don't think is being accounted for at this point in time.
We will be keeping an eye on debt as we head into the new year, but this year we saw interesting trading action for the commodities. As for oil prices, we did get above $50 a barrel following the OPEC agreement. And for gold futures, we're off the lows, but we're also off the highs. So where are we headed?
I think in the gold markets, I think it's extremely positive, because last year at this time, gold was on its lows since 2011. It had come off 1900. It was on the lows, and the Fed raised interest rates last year for 25 basis points, and gold dipped just like it has this year at this point in time. And everyone said, okay, that's the end of gold, and gold had the best year it's had in 6 years. So I actually am anticipating a very good year in gold, just because all this short-term stuff is out of the way, and we'll be off and running. It's kind of accepted that the dollar is very, very strong, and it's kind of accepted wisdom that the dollar is going to do better and be strong, because we are, even if our economy or our country isn't doing that well, we're much better off than anyone else. I actually believe that the dollar is strong, and it's going to get stronger, on different levels of valuations. And Stephen's much better than I am about picking technical points about that. But I think that the dollar's run is coming to a close. We've had, since Ronald Reagan came in, we've had 35 years worth of equity bull market with a couple of huge blips in between. We've had 35 to 40 years of a bond market run with a couple of blips in between. I think that those big macro trends are coming to conclusions, and I think the dollar being strong, king dollar, I think, is coming to a conclusion. And usually when it happens, you see these huge blow-offs at the end, much like equities in the last 2 months. You have significant moves. Well, the dollar's had a significant move on the plus side, and I think that people should be very, very concerned about that, because it might not last.
Well, if you're right about that, and you might be, then we're going to have a lot of inflation to deal with. And the Fed will be forced to raise interest rates into that inflation, and you'll have competing forces there fundamentally. I don't know. Obviously, raising interest rates would cause the dollar to go higher still, but the inflation would weaken the dollar. It will be quite some fight at that point. And if the Fed is forced to artificially raise interest rates, the bond market might take control of the whole thing anyway, and leave the Fed almost with no control over those interest rates.
Well, gentlemen, thank you so much for joining me today. There are a lot of moving parts and a lot of things that will affect the equity markets as well as the economy. So thank you so much for insight, and I wish you a happy new year and hope to have you again here in 2017.
Thank you very much for having us.
Thank you.